Hi, I'm Michael Hass with Live a Better Retirement Lifestyle. Here today to talk about events that rock the stock market from time to time. The reason why I'm making this video today is because I talk to a lot of people and I hear a lot of reasons about why they don't want to invest. Reasons like, I don't want to invest today because there's a certain event happening, or I'm going to wait until a particular event is actually over before I consider investing. Or, I don't like so-and-so, I'm going to wait until he or she is actually out of office. The next one's the most popular one I hear. The stock market can't go up forever. And I don't say the stock market goes up forever, but there are reasons why it goes up over the long run and reasons why it pulls back in the short run. I'll be talking about those today. But after I hear this reason, I always hear the next one. Well, don't you remember the 2008 crisis? Of course I do. I think we all remember it quite well. And so I'm going to pull up a slide here. This is a chart that actually shows the Dow Jones going back to the year 2000. And right here, this was the 2008 stock market correction. Right here on the top, before it happened, was the fourth quarter 2007. The Dow Jones was right around 14,000 mark. Precisely right here was March 9th of 09. The Dow Jones hit 6,500. And then, of course, you can see we're much higher today. We're up around 33,600 as of the recording of this video. And people see this with all the negative news that's going on out there, and they see this and how it recouped, and they always say, well, how is that even possible? And it's almost gotten to the point where like people think we're investing in daily news stories. Now, I'm being facetious here, but I think we would all agree there's no shortage of negative news for the last 14 years. For that matter, for the last 50 or 100 years. And of course, we're obviously not investing in daily news stories, but we are in fact investing in publicly traded corporations. Each one of those companies has its own president and board members. And it's those people's sole job to find ways to increase profits. Now, they can't accomplish that in every year, but the years that they do accomplish it, they become more valuable as a company. As a result, their stock price goes up. In the big picture, it really is that simple. The short-term pullbacks and fluctuations I'll talk about here in a little bit. But there's a story I tell everybody. I've got a friend I've known for 35 years in the gym that I go to. His name is Steve. It's a good company he owns. Employs about 100 guys. Okay, it's a tier 3 auto supplier business. They make parts for the automobile manufacturers. And he was telling me in the gym 5 years ago, he said, Michael, 5 years ago, so now we're looking back 10 years, but he said 5 years ago, a job that took my shop 3 months to do, we can do that same job today in less than 3 weeks. And he told me it's all because of the advancements in technology that he employs in his shop. Okay, so whatever profit he made in 3 months before, he makes that same dollar profit in less than 3 weeks. He's more and more profitable. Okay, those type of advancements are not just in the automobile sector, but across all sectors across the country and of course around the world. A lot of retirees I talk to tell me, well, Michael, I don't have as much time to make up for mistakes. I'm not looking as long. I'm not 40 or 50. I'm in my 60s, 70s, and 80s. And before I get to that, I do want to pull up another chart. And again, this is the Dow Jones again. And now we're going all the way back to 1900. And it only goes up to the year 2016. But the reason why I pulled this chart up is there's a listing of a bunch of different events that caused all these pullbacks we're looking here. Now this chart, this is actually the stock market crash in 1929. Followed by the Great Depression. On the far right-hand side was the stock market panic of 2008. And of course, with all these different events, now you can't read them, but I've printed up a handful of events that I'll read off to you, and I'm going to focus more on the more recent times here. So I'm going to start off here in 1986. The Iran-Contra affair, U.S. attacks Libya. 1987, financial panic, where the stock market crashed. That was the biggest stock market crash since the 29 crash right here. 1988, terrorists bombed the New York-bound airliner in Lockerbie, Scotland. 1990, Iraq invades Kuwait. 1991, the Gulf War, Soviet Union collapse. That was a pretty big deal. 1992, the Cold War ends and there's civil war in Bosnia. 1993, the Russian revolt. World Trade Center was bombed. Okay, 1994, Orange County bankruptcy. 1995, Oklahoma City Federal Building was bombed. Skip ahead to 97, Asian currency crisis. I'll skip ahead to 2000, Bush-Gore election crisis, along with a terrorist attack, USS Cole. 2001, terrorist attack the World Trade Center. The biggest event to happen in this country since Pearl Harbor. Really big deal. 2005, record high oil prices. 2006, housing decline, and there was nuclear weapons concern in both North Korea and Iran. 2010, Gulf oil spill, European Union crisis with massive debt. 2011, we had our own debt ceiling crisis here, and U.S. credit was downgraded. First time in history ever that that's happened. Another big deal. 2013, there was the Boston bombing and a government shutdown. 2014, the rise of ISIS. And not on this chart, of course, was the 2020 coronavirus. Biggest pandemic we've had in over 100 years. And here in the first quarter of 2022, record high oil prices and Russia invades Ukraine. So point is there's just always something, there's always going to be something that gives us these short-term pullbacks. Up on top here, it says human innovation always trumps fears. Again, referring to advancements in technology, allowing these companies we invest into to become more profitable, and that's why over the long haul, this goes up. And again, going back to the retirees, Michael, I don't have as much time, I'm not looking quite as long term, and my response is, well, a well-balanced portfolio should have two general parts. Stocks are for growth, also other speculative investments such as commodities and things like that, and then fixed income. Treasury bonds, corporate bonds, muni bonds, preferred stocks, CDs, money markets, and things like that. Pull up another chart. This is going to be the stock market today. Actually, we're going back 10 years. And this right here was the coronavirus pandemic. Again, biggest pandemic in 100 years. The stock market pulled back very, very quickly. And believe it or not, it took less than 5 months for the stock market to recoup. Why? Because prior to that happening, earnings were great. Emotions got the best of everybody. The stock market sold off as earnings kept being reported throughout the year. That's what drove the stock market up again. But again, for those retirees and those not looking quite as long term, the concept is the more we take out of the stock market, and down here in this gold line down here in the bottom is the bond market. The more we take out of here and we put down to the fixed income market. And that does two things for us. Number one, it reduces and mitigates the volatility that your portfolio is going to experience. And number two, it does lower your overall returns in the long run, okay? Because we can see stocks outperform bonds in the long run. History shows anyways. But it's a lot more volatile. Okay, so it's a delicate balance. You want to be careful because in a rising interest rate market like we're looking at here in the first quarter of 2022, some of these fixed income instruments can lose money as well. So it is a delicate balance, and that's why they say it's wise to seek professional advice. And as I always say, seek that advice from somebody who's operating in a fiduciary capacity. And why I say that is, when you move your money, say from one account to another, from one custodian to the next, or maybe some internal movements, whenever you move your money around with somebody operating in a fiduciary capacity, managing your assets, that movement of money will generate no commissions whatsoever. Instead, we structure the account and relationship in a fee-based arrangement so that when you do better, we do better. It's actually a win-win for everybody involved. So if you've got questions about how you can build and manage your portfolio to better handle the volatility that you're experiencing, just click on the button below labeled Let's Talk, and you can schedule your phone consultation or Zoom meeting if you desire. And I look forward to speaking with you.